Now let's take a look at a focus on commodities. In fact, a lot of movement there, particularly in the energy sector. Rob Hay is joining us from Collins Street Asset Management. Rob, welcome back. Happy New Year. I hope you had a great break. Let's kick it off with a look at energy. Now, of course, this very much in focus in the wake of what we've seen out of Venezuela. What are you looking at in the energy sector?
Good morning, Andrew, and Happy New Year to you too. Yes, for us at Collins Street Asset Management, as deep value contrarian investors, we're really excited about the prospect for traditional energy and the oil and gas sector in particular as we come into 2026. Venezuela has kicked the year off in a very topical way, but what we've found here on the ASX are a basket of very attractively priced stocks that are actually in production and in some cases even buying back their own shares at a point where the oil price is actually beneath the global average cost of production. Something that you rarely see, Andrew, in the oil and gas space, and something that creates a classic disconnect between demand and supply and presents an attractive entry point.
Well, let's get to it then, Rob. Those stocks on your list and reasons why.
There are three key stocks that we would call out, Andrew. Firstly, we like Beach Energy, BPT. Beach are a company that have had all manner of operational issues in the past and downgrades. However, we see that as largely behind them now. Whatsia is up and running and their balance sheet is strong. They've got good cash flow, low levels of debt, and are in a position where really 2026 could open up any number of opportunities for them, be they acquisitions, be they other forms of capital management. Beach are trading on near on 7 times our estimate of forward earnings. And so in a broader market, which we believe to be quite heavily priced, there's a lot of margin of safety for us as deep value long-term investors in getting set in a company like Beach.
And in fact, we take a look at that share price there, Rob, close to 5-year lows. So you're seeing that as quite a compelling value?
Yeah, absolutely. We're not buying them for what they have done. We're buying them for what they will do moving forward. And we feel there's some exciting opportunities there for the company to make good use of a strong balance sheet now Whatsia is up in production to really get things moving into 2026.
Another stock on your list is Karoon. Obviously more with a focus there offshore in what's got a project in Brazil. What are you looking at?
Karoon's a fascinating company. Again, they're trading on around 7 times our estimate of forward earnings. And importantly, Andrew, they are actually earning. They're a producer in their own right. And notwithstanding some issues they've announced to the ASX recently around one of their wells and some undersea cabling, they've still reaffirmed guidance for 2026, which is quite attractive to us. But Andrew, there's a big disconnect here in the way that the market is viewing Karoon. They actually have about 9% of their stock shorted by the market at the same time that the company is actually buying back their own shares. It was around 75 million US was announced as the buyback last year, which they're continuing to do, showing that management have confidence in the assets and the production profile of the company moving forward. One other thing, Andrew, that I'd flag here with Karoon is that having assets in Brazil, North America and Australia does give them a degree of geopolitical diversification there. They're able to access refineries and markets in the Europe and the US as well, rather than being heavily focused, say, in the Middle East or some of the other OPEC countries. And for that reason, amongst others, Karoon is quite attractive to us also.
And thirdly, let's take a look at Santos. Now, interesting, of course, given another failed bid in terms of a takeover. What are you seeing there, Rob?
Santos, again, Andrew, are attractively priced, certainly compared to the likes of Woodside here in Australia, but also if you look relative to international peers as well. The trading on 11 times forward earnings gives you a lot of margin of safety, particularly when you're on a 6% dividend yield, effectively getting paid to wait for some of their other projects to come into production and fruition. And certainly, Andrew, given the portfolio that Santos have, they've got some very exciting prospects over the years ahead. We've seen recently that Santos have paid down their share of the debt for the Papua New Guinea LNG assets, which gives them a lot more flexibility around that project. They have interests in Dorado, where they're going to be expanding out some of their drilling in a joint venture they have with the Taiwanese, also with Carnarvon, another company that we have a position in. Of course, Andrew, yes, they have had some failed takeovers. There's also the opportunity, though, for Santos to continue divesting non-core assets, build up their balance sheet strength, and certainly, should the oil price continue to go higher, or start to go higher, I should say, there's some enormous leverage there as well on the upside. So when you're getting into these companies at 11 times earnings in the case of Santos, somewhere around the 7 to 8s in the case of Karoon and Beach, in a period where the commodity is at a historic low level relative to the cost of production, it really does have all of the hallmarks of a very exciting 2026 when things turn around.
3 energy stocks to take a look at, courtesy of Collins Street Asset Management. Rob, thanks for joining us.
Thanks, Andrew.